So does it ever make sense as a private lender to sell off a defaulted loan? Answer, it depends. Sometimes it does, sometimes it doesn't. Really needs to be a win-win situation, and we're going to break down all the details right now.
Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Dalen and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thanks for checking out the show. All right, let's talk about selling notes. If you're an active private lender and you're out there publicly, you probably have companies, individuals, brokers hitting you up saying, oh yeah, do you sell your defaulted notes or NPNs, non-performing notes, NPL, non-performing loans? And there's a lot of noise out there. We're going to get in some situations in which that could make sense or might not. But first, let's talk about different parties that might be in a position to buy a note. So I would break them down basically in two categories: third parties or interested parties. We have sold to both. In all these years and all these thousands of loans, we've sold maybe, how many notes have we sold? Between 5 and 10. Not that. Yeah. I would say between 5 and 10. Even dating back to the early years. So let's talk about interested parties. Somebody who already does have an interest in this particular deal in one way or another, and it makes sense for them to buy our first mortgage. This has happened a number of times. Now, who could be an interested party? It could be a second mortgage holder. You get into a foreclosure situation. If you actually get to that auction sale, they're getting wiped out. They have a very clear interest in protecting their capital. One way they can do that is buy the first, then they can have the first and the second and figure out how to get their money back, or hopefully all of it, maybe some of it. That has happened before. I've also seen business partners who went sideways with each other on a deal. If to us, they're co-borrowers. To them, they're business partners, developers, and have one buy the note because the deal's going sideways. Maybe one bailed on the project, others trying to save it. We've seen that happen before. And those are typically on our end pretty easy situations because we hold all the cards, right? Not the case with a third party. They're looking to make a business deal that'll be profitable. But when people are just trying to save their ass, AKA their capital, we're in a pretty good position to leverage. So talking about how that might transpire. So you have $100,000 loan and your default interest rate is 24%. Your note rate is 12%, just to use some round numbers. If we're owed a year of interest, so either 24,000 default rate or 12,000 at the note rate, we would bail on this. Typically a business decision is that if we can get note rate and get out now, have one less headache to deal with, have one less, litigation case to deal with, we'll take note rate and get out, right? And there's going to be some more examples of this kind of stuff when we get to the third party stuff. But in negotiating with an interested party, we don't have to get every dollar that we're entitled to, everything that the note says we can collect. If you can, great. Have we? Yeah, we've gotten some good returns. You can negotiate a rate of return. If you're like, yeah, our default rate's 24%, but here's the price. If you buy it at 16% return, definitely done that. Great exits. But we're not going to ever be in a position, whether it's interested party or third party, to sell it for principal. Yeah. Like, it just doesn't make sense. The way we do our underwriting is that there's collateral we can collect against and a guarantee we can collect against. So we're not going to do it for no money. It doesn't make sense. Like, some people will be like, oh, well, you can get your money back and put it into a good deal. It's like, yeah, that's true. But that's kind of not how we work. And that's not why we underwrite.
Well, do. I mean, that's for us, depending it's a good deal. But like, if somebody's lending super high leverage and they're going to lose money, if you're going to lose principal, unless you do this, you might just take principal and
no, sure. If somebody happens to be doing 100% financing or something like that, and they just want their money back.
Yeah. I mean, most of the deals that we would potentially be interested in selling a note where it's a win-win is, it's like, hey, listen, I don't feel like being in this deal for the next 6 months.
Or more,
way more.
Yeah,
we can already get a good enough thing, and there's enough meat on the bone for the note buyer to be able to, to make a profit. Like, let's use an example. Like, let's say it's an $800,000 property and there's a $400,000 principal or loan amount, and you're, go to file foreclosure. They stop making payments. Maybe they file bankruptcy. They kill time. Then you get the foreclosure going again. And let's say the payoff's $500,000, and you're like, hey, listen, we could sell this note for $450. We'll get 50 back. It's not going to be everything. I mean, 400 is our principal. We'll get 50. We'll put that towards some legal fees, some interest, and then there's another 50 grand to the next buyer, right? And they can potentially go through the process and collect on it, and they can, have the difference plus whatever. I mean, it's a per diem rolling default interest rate, plus other stuff like that. That could be a win-win situation. I've been thinking about some other ways that we had purchased notes. I remember, or sold notes. We sold some notes because we had some title insurance claims that the actual title producer, the actual title company, not the title insurer, had messed up on, and they were going to eat. They could have lost their insurers and could have had to go out of business. So, if you ever been involved in a title claim before, this is a little bit off topic, but ever been involved in a title claim before, it's not always the title insurer making the payment on the claim. Sometimes there's other parties that are paying, including the title producer, the actual small title company. Most small title companies are just, brokering title insurance. They can't support paying title claims, but sometimes it's better than them losing,
their insurer relationship.
Sure, relationships. So there was two that I remember specifically that was the case, and they kind of just messed up on the title insurance, and it was put on them. We were covered, and instead of them just, let's say we're owed $100,000, instead of them just wiring us $100,000, they were like, well, let me just buy your note for $100,000, and then they can go collect and default the borrower. Great solution. Mm-hmm. That's typically what happens on some title claims to begin with. Like, they're trying to figure out ways to recoup money. Anyways, that's off topic, but this is the challenging part about, I think, selling notes. And we talked to another note buyer here recently, because I'm typically like, yeah, or both of us are kind of like, yeah, it probably is not going to work unless it's really the right situation, because it's one of those things that, like, early on in a default, it doesn't really make sense to do it, right? Because it'll probably just cure.
Cure.
And if you wait too long in the default, then it could just get too dirty. And the note buyer, doesn't want to pay you like par plus 150%, right? Like, let's say your loan goes from 100,000 to 200,000, and let's say it's been going on for years or whatever, and you're legitimately owed that much between, 18 or 24% default for 3 years, high attorney fees, paying taxes, paying insurance, stuff like that. And let's say, you are entitled to get all that money back. And it's just like, I don't want to wait the process. And, like, keep in mind, if you have a debt fund, I was thinking about this while we're talking about this, you have a debt fund, like, you want to get out of some of these non-performing loans as quick as possible, because you're still covering interest to your capital investors, right? So everyone's situation is different, right? But it depends on, some people, it doesn't matter if the capital is just stagnant, knowing that you're going to get it all back on the back end. But, like, at some point, a note buyer, like, if you're owed 2 years worth of interest, the note buyer is like, hey, listen, like, I can only pay you, 105%, par, par plus 5 or whatever. Like, that for the most part means, like, you're giving up a lot of interest to rewind this thing. So, like, I feel like around, like, months 3 or 4 of default, and the way that we define default is a borrower's, not in good standing. They're not up to date on payments. Defaults don't mean like, hey, how many loans did you default? Oh, I haven't foreclosed on any yet. I have no defaults. Like, that's not what a default is.
No, default's according to the note, the terms of the note, like 30 days late over the construction, over the maturity date.
That's right. It's not like just getting foreclosed on. So typically around like month 2 or 3 of late, that's probably a good time to kind of get that ball rolling if you're thinking about selling a note. If there's no clear exit strategy in place. Because month 1, it's like, it might cure. Month 2, it's like, hey, they're going to try to sell the property. But then like going into month 3, it's like, man, this thing's a pain in the neck. I don't know if this thing's going to cure. And at that point, that's probably the right play to do that, because then a note buyer can come in, and even if they just pay you back, principal plus like another month of interest, like you'll still be like, okay, whatever, like let's just keep it moving type of thing. But if it just gets too far, I think it's just going to be too challenging. You almost have to just continue the ride yourself, because you're not going to just take principal if you're owed 2 years worth of interest.
No, definitely not. Not in our world anyway. I want to touch a little bit on the types of note buyers that are out there, things to look out for. And then I also want to talk about the process of actually selling one, because hopefully if anybody's considering doing that, this will shortcut some stuff for you. So if you've interacted with some of the people who market to lending companies to buy notes, then you're aware of the fact that there's a lot of BS out there, but there's also some real people out there actually with capital they control to buy notes. There are a lot of broker types that will hit you up and be like, oh, hey, I'm a note buyer, but they're not a decision maker. And you kind of got to dig into it a little bit. We had a situation where a broker was pretty good and pretty consistent about contacting me and being like, hey, is there anything that we can look at? We're actively deploying capital on non-performing loans. And after we communicated a few times, she was like, hey, let me introduce you to the principal by email. And then we got on the phone and I looked them up, checked them out. Some Miami finance guys that looked legit. Anything I could find on social media, on their website, everything else. It seemed like they were really in control of capital and doing deals. And this deal worked out. So we started talking about a couple different potential ones that would work for them in the states where we lend. And the deal we ended up doing was in New Jersey, which is a challenging state for a lot of reasons. Foreclosure is one of them. And we looked at a couple deals. At the first one, it's a judgment state. So you file a judgment, then foreclose on that. And they're like, no, this judgment's filed and you're only owed X amount according to that. That one's not so good. I was like, oh, this one we haven't gotten a judgment yet. Let's take a look at that. And there's plenty of equity in the property. We're owed about a year of default interest. It was in there. It was like, we're into it. And I offered them what I said before. I was like, look, we can take note rate. We're not going to sell for any less than that. So if you give us our 12.99, that's our return plus attorney's fees, then you can go after it from there. Collect on the default interest and everything else that you're entitled to from the loan. And that's the deal that we made. That one was legit. It happened quickly. And a little bit about the process. I don't want to get too deep in the weeds on that stuff. But one, I would have this note sale handled by your attorney. I wouldn't have it done by theirs. You don't trust their documents. You don't know what it's going to be in there. You want to make sure that everything's on the up and up. Have it handled by your attorney. Your attorney should be comfortable with these kinds of loan sale documents. If they're doing your loan docs, they should be comfortable with this too. It's connected, right? Doing assignments of the mortgage and the note and the loan file, everything else, underwriting file, they should be comfortable with. And how it flows quickly is that we'll agree on a number, and then they will make the documents, the loan sale agreement, the assignment of everything that I just mentioned, and they'll control the flow of it because they don't want to send you the money until they get the docs, but you don't want to give them the original docs until you get the money. So it's like a little bit of a dance. And as I recall how it worked was we sent them copies of the signed documents, copies only, us assigning everything to them. Then they were to wire the money to our attorney. And it makes sense to have them do that because they're going to be more comfortable having it at an attorney's office in escrow, quote unquote, as opposed to sending it directly to you. And then the attorney gets the money. They overnight the originals because in many jurisdictions, originals still need to be recorded so that they can take control of the lien and everything else. Not everywhere, but in a lot of places. They send them the originals. Everybody gives a thumbs up, and then they send the money to us, and we process our payoff. That's the way this one flowed, and it worked. It worked pretty well. We were just talking. This came up earlier because Jason was talking to another firm that also seems legit about their criteria and everything else and what they're looking for. Apparently, they stopped originating years ago and switched only to buying notes, and so they have more formal guidelines. They know like, oh, we're only paying 110%. It wouldn't be any more than that. Like it might not be a situation that works, but maybe it does. And also like you can always throw out some numbers on, look, here's the total payoff on this one. Here's the principal. Here's everything else owed. Here's a total payoff. And here's what we can accept, right? We can accept 150K by the end of the year. Like, you guys into that? And give it a shot. I don't think there's anything wrong with it. You got to make sure you don't get swindled in any way. As long as you have the right people running the transaction, you really shouldn't. But I would consider it, especially when you have more than one or a few defaults, and you'd be happy to have one less headache, right? So that's something that I think we are going to revisit, take a look at some of the defaults in the portfolio and be like, which one of these would make sense based on how much is owed on the note, how much we think we can sell it for, the value of the collateral, the state where it's located, anything else going on with the legal situation related to the default, and maybe pick a few out, maybe exit a few, being creative in that way, getting out of a sticky situation, and also making some good money. Because like, we believe that these things should be win-win. It should be a win for us. We make some money by selling this at a decent price. It should be a win for the buyer of that note. They have, in all likelihood, a good financial outcome by the time they exit it. That's how these things should go. I don't think anyone should be taking it on the chin. That ain't a good deal.
No. And I mean, keep in mind, most of these defaults enhance your average rate of return on these deals. You know, if you have a fund, you have direct placement, however your capital's structured, if it's just your own money, like having defaults is part of the business, and it's not necessarily a bad thing in order to do so. That being said, if you're at a place and you're like, you know what, I don't want to deal with this headache, I just want to get back into only performing loans, you know, it's an alternative. It's an option. And we've done it a few times. Like Chris said, we've done it a few times, and I don't think it's typically front of mind. That's probably why we're recording this episode today. Like, we should make it a little bit more front of mind on, you know, maybe even through our default meetings, right? Like, we have default meetings on a regular basis. It's like, cool, what are we going to do with this?
That's
and
a lot
of the times it's not a big deal, and it could go 50-50, but you know, just be aware of what's going on out there. You know, in essence, like, you know, keep this front of mind. You know, maybe it makes sense, maybe it doesn't. And I'll tell you, we didn't sell notes for years, right? Because we didn't even know if that was something that was available. And again, this is an investment vehicle for us. Our goal is to not, the whole part of this episode was not to like, hey, originate loans and then sell them off. No, the goal is to service these things, make the return. This is an investment vehicle. That's the important part. But if there's a deal here and there that you kind of just want off your books, this could be an option.
All right, everyone, that is the pod for today. We appreciate you checking out the show, and we'll see everyone inside hardmoneymastermind.com.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.